Hello everyone, I had to walk into this earnings week today, knowing what I know about crowded AI trades, stretched charts, and how quickly the market punishes anything that is merely good instead of perfect. I would do one thing very differently. I would stop asking, should I sell everything? And I would stop asking, should I hold everything no matter what? Those are emotional questions. The better question is this: what position can I hold through earnings right now without acting like a lunatic when the stock moves against me? Because earnings season is not just about earnings anymore. It is about expectations. It is about positioning. It is about how much good news has already been pulled forward into the price. And when a stock has already moved like everybody suddenly discovered fire, the company can report a very solid quarter and the market can still say, cute, but not enough. Today is Sunday, April 26, New York date, and I want you to comment what day and date you are watching from. And if you value this kind of calm, no hype market breakdown, support the work by subscribing and commenting John AG Best. So let's get started. We have one of those weeks where the market can pretend it is rational for about 2 hours, and then one cloud number comes out, and suddenly every chip stock, software stock, AI stock, and high growth name starts trading like it heard a secret in the hallway. Microsoft is on deck. Amazon is on deck. Meta is on deck. Alphabet is on deck. Apple is right there too. Then you have AMD, Palantir, Rocket Lab, Western Digital, SanDisk, Reddit, SoFi, Robinhood, and a long list of names that people either love too much or hate too confidently. That is dangerous, not because these companies are bad. Some of them are excellent businesses. The danger is that investors forget the difference between a great company and a great setup. A great company can still be overbought. A great story can still be crowded. A great quarter can still lead to a red candle. And this is the part people do not want to hear because it feels boring. But boring is what keeps you from blowing up. If a position has doubled, tripled, or simply become too large for your portfolio, taking a piece off the table is not betrayal. It is not panic. It is not you losing faith. It is you admitting that your brain works better when your risk is smaller. Now, based on the current earnings calendar, the big technology wave is packed into the final days of April, with Microsoft, Amazon, Alphabet, and Meta all scheduled around the same window, and Apple following right after. AMD and Palantir come just after that, while Rocket Lab follows in early May. That means the market is not digesting one report. It is digesting an entire narrative at once. And the narrative is simple. Is the AI boom still accelerating, or is the market starting to question the bill? Because the bill is getting very, very large. According to recent company updates, the largest tech platforms are still spending aggressively on cloud capacity, AI infrastructure, data centers, chips, energy, and engineering talent. That is bullish if revenue keeps arriving fast enough. It is a problem if investors start thinking the spending curve is moving faster than the return curve. That is the whole tension. Microsoft can show strong cloud demand, but if Azure growth is a little softer than investors dreamed, the stock can get slapped. Not because Microsoft is broken, because the market has already paid for strength. Amazon can show AWS demand, retail discipline, advertising growth, and still get questioned if guidance sounds heavy because infrastructure spending keeps climbing. When investors hear AI spending, they cheer. When they hear the cost of AI spending, they suddenly remember math exists. Alphabet is in a similar position. The core advertising engine is still powerful. Cloud has become a much more serious business. The AI product story is bigger than it was a year ago. But again, expectations matter. If the stock has already run, the report has to do more than prove the company is fine. It has to prove the next chapter is worth the price. Meta is the same kind of test, but with a sharper edge. AI can make ads more efficient. It can improve recommendations. It can increase engagement. But Meta is also spending a lot, and when a company spends a lot, the market wants proof. Not poetry. Proof. That is why this week matters beyond the mega caps. Those reports can reprice the whole AI chain. If cloud demand sounds strong, AMD can benefit. If data center spending sounds disciplined, chip names can breathe. If spending sounds too heavy, software and platform names can wobble. If guidance sounds cautious, high multiple stocks can get hit, even if their own report has not happened yet. This is why you cannot look at AMD in isolation. AMD is one of the most interesting setups in the market because the long-term story is real. The company has a path in AI accelerators, data center chips, enterprise demand, and the broader need for alternatives in advanced compute. It does not need to own the whole market to build a much bigger business. It just needs enough share in a market that keeps expanding. But the short-term setup is not the same thing as the long-term story. If a stock has already moved hard into earnings, and the crowd is expecting guidance, partnerships, AI demand, margin expansion, and future upside all at the same time, then the bar is not on the floor. The bar is hanging from the ceiling fan. Could AMD go higher? Absolutely. Could AMD report well and still pull back? Also absolutely. That is why partial profit taking makes sense for some investors. You can keep the core. You can still participate. But you can also take enough cash out so that if the stock drops, you are not sitting there staring at the screen like it personally betrayed your family. And no, you do not need to sell just because something is overbought. Overbought can stay overbought. Momentum can make sensible people look foolish for weeks. But if the position has become so large that a normal earnings move would ruin your mood, that is not investing anymore. That is emotional hostage taking. Rocket Lab is different. Rocket Lab is a milestone stock. The market is not paying only for current financials. It is paying for what the company could become if launch cadence improves, space systems scale, defense interest grows, and Neutron becomes a real commercial engine. That is exciting. It is also exactly why delays matter. When a company is priced on future execution, every future step becomes part of the valuation. A successful launch can change perception. A delay can reset patience. A contract win can pull buyers back in. A missed timeline can make people suddenly care about revenue quality. So with Rocket Lab, the real question is not, do I like space? The question is, how much future success is already in the stock? Because those are not the same. Apple is a different beast. Apple is not a small hypergrowth story. It is a giant ecosystem with devices, services, payments, subscriptions, chips, and a customer base that most companies would sell their boardroom furniture to have. But Apple has a growth question. The market already knows Apple is profitable. It already knows services are strong. Apple said its latest quarter delivered record company revenue and record earnings per share, with iPhone and services hitting records too. The question is not whether Apple is a great business. The question is whether it can give investors a fresh reason to pay a premium again. And that brings us to AI. Here is the counterpoint most people miss. Apple may not need to win AI loudly. It may win by making AI invisible. On-device, private, integrated, useful, boring in the best way. The kind of AI that does not need a demo that makes everybody clap because it simply makes the phone, laptop, watch, and services ecosystem harder to leave. That can be extremely profitable. But if investors want a dramatic AI moment and Apple gives them a slow, Apple-style rollout, the stock may not explode. It may grind. And grinding can be fine if you own it for years. It is less fun if you bought it for a one-week earnings trade. Now, Palantir is where people start getting emotional. Palantir has the combination Wall Street loves: strong growth, expanding margins, government demand, commercial expansion, AI relevance, a product story that feels like it is moving from niche to essential. That is powerful, but it is not cheap. According to its latest public update, Palantir ended last year with very strong revenue growth, especially in the U.S. commercial business, and issued aggressive growth guidance for this year. That supports the bull case. But it also creates a trap. Once a stock is priced for exceptional growth, normal growth becomes disappointing. That sounds unfair, but the market is not built around fairness. It is built around surprise. If Palantir keeps accelerating, the premium can survive. If margins keep expanding while revenue keeps pushing higher, investors may keep giving it room. But if the company shows even a small crack in momentum, the reaction can be ugly, because the valuation leaves very little room for ordinary. So again, the question is sizing. Do you want exposure? Fine. Do you want your entire emotional state tied to whether one expensive stock beats a very high bar? Maybe not. Now let's talk memory and storage. Western Digital and SanDisk sit in a part of the market where cycles matter. Demand can improve quickly when data center storage, AI workloads, and memory pricing turn. But cycles do not move in straight lines forever. Western Digital's recent update showed stronger revenue and margin performance, plus guidance pointing to solid growth. That helps explain why investors care. But after a giant move, the danger is simple. Good news may already be rented, furnished, and living inside the stock price. Same with SanDisk. If the market has already decided the upcycle is here, the report has to confirm not only that things are better, but that they are better for longer than people thought. That is a harder test. And this is the theme across the entire earnings season. It is not enough to ask, will the company beat? You have to ask, what is already expected? What is already priced? What would actually surprise people? What would make buyers chase? What would make holders say, okay, maybe we went too far? That is where money is made and protected. Now, I want to be very clear. Taking profits is not the same as calling a top. I have no magical bell. Nobody does. If someone tells you they can perfectly call every top before earnings, either they are selling you something or they have never traded through enough earnings seasons. The goal is not perfection. The goal is staying in the game. If you trim a position and it goes higher, congratulations, you still own the rest. If you trim a position and it drops, congratulations, you have cash and emotional oxygen. If you sell everything and it rips, that hurts. If you hold everything and it collapses, that also hurts. So the middle path is often underrated. Take some profit, keep some exposure, decide before the report what you will do after the move. That last part matters, because if you do not decide before, the candle decides for you. And candles are terrible financial advisors. If you're successful, share your success story in the comments so others can stay motivated. Here's a simple rule. If a position keeps you awake, it is too big. If a position makes you hope instead of think, it is too big. If you cannot handle a normal earnings drop, it is too big. And if trimming a little lets you hold the rest with discipline, then trimming is not weakness. It is the thing that keeps you from making the worst decision at the worst moment. Also, taxes matter. Realized gains are real. Tax bills are real. Sometimes selling a loser can offset part of a gain, depending on your situation. Sometimes it makes sense. Sometimes it does not. That is where you think before clicking buttons. So as we go into this earnings wave, do not make it complicated. Great businesses can disappoint. Expensive stocks can keep rising. Cheap stocks can get cheaper. AI spending can be bullish and still scare people. Cloud demand can be strong and still not strong enough. Guidance can matter more than the quarter that already happened. The market is not grading homework. It is grading expectations. One more thing. Do not ignore the macro background. When rates are uncertain, inflation data is still watched closely, and investors are already crowded into the same winners. Earnings reactions can become exaggerated. A company does not need to collapse fundamentally for its stock to reset. Sometimes the market simply decides the multiple was too generous. That is especially true in software and cybersecurity. For years, investors paid premium prices for companies with sticky revenue, high gross margins, and mission-critical products. But when growth slows even a little, the market can decide that mission-critical does not automatically mean any price is acceptable. That is why cheap can get cheaper, and expensive can stay expensive until the first crack appears. So before earnings, write your plan, not in your head, on paper. What do I own? Why do I own it? What would make me add? What would make me trim? What would make me admit I was wrong? If you cannot answer those questions before the report, you will probably invent answers after the report, and those answers usually cost money. And please do not compare your decision to someone else's screenshot. Their portfolio is not your portfolio. Their tax situation is not yours. Their time horizon is not yours. Some people can hold through a 30% drop and laugh. Other people say they can, then sell after the first red candle. Know which one you are before the market tells you. That is the real edge. Not pretending to be fearless. Knowing exactly how much fear you can afford. So own what you understand. Size it like an adult. Trim what makes you nervous. Keep what you believe in. And never let one earnings report turn your portfolio into a casino with better branding. This is for education and perspective only. I am not your financial advisor, and I do not know your taxes, time horizon, income, risk tolerance, or sleep schedule. Use this as research fuel, then make the decision that fits your own life.